Hey everybody, this is Jose Blasco. We are about to get started here. Please sound check if that's okay. Quick message on the chat box with basically confirm that you hear my voice and we are ready to get started. Please go ahead and do that. So we start in just a few seconds, okay? I will add the video stream in the bottom right corner of the screen as we always do. How are you everybody? Good to see you. And basically we are ready to get started, okay? So confirmations, very good. Christian, how are you? Everyone, this is good to see you all. Let's begin, guys. So we are live, okay? How are you, Maka? Very good. We are live. Today is May 20, 2021. Welcome to Options with Options. We're going to be looking at the markets. Of course, we're going to be trading options. The name says it clearly. And for the ones of you attending for the first time, or if you are new to options, the beauty is that we can do many different things with options. We are certainly exploiting the highest probability trades available, which is when we avoid to be directional and we try to find what I often call arbitrage opportunities. This adds odds big time to the trades. And also give us the opportunity to do smart actions during the life of such trades, okay? Nothing wrong with being directional, obviously, and certainly a portfolio should be made of a collection of different types of strategies, which makes you diversified based on strategy, and therefore directional plays, either long or short, are also more than welcome. In any case, before we get started, I will highlight a disclaimer on the upper left side of the screen so you guys can read it carefully. This is important information. I am counting on you guys reading it completely, fully, without skipping words, sentences, nor paragraphs, because as I just said, it's important information, okay? Even though you may see the disclaimer every week, you know, it's there for a reason, okay? How are you, Joanne? Very happy to see you. Good morning. Very good. So anyway, agenda for today, as always, we just said hello. Hi, everybody. It's a pleasure. We are simulcasting, so some of you are watching us from YouTube, from Facebook. Some of you are watching us from the private room built in our website, tradewithufos.com/live. And basically, the fact that we are simulcasting has two types of consequences. Number one, how are you, Ahmed? Number one consequence has to do with video lags that will be different in different places. So make sure you understand that. Consequence number two is the content of the sessions, which while it's the same content, no matter if you're watching from YouTube or from the private room, the duration of the content is not the same. In the private room, it's full duration sessions. Outside of the private room, it's partial duration sessions. Again, normally we run the sessions until we find at least a trade, and then we say bye in the public streams. That way we accommodate for the two types of traders, the two groups that we find in our community, which is group number one, people looking at trading more like a part-time thing, if you wish. Group number two, people that are super amazingly passionate about trading like me, never got enough, always want more. And therefore, in this sense, I would certainly advise you to subscribe to one of our coaching plans that you would find on the website, and that way you have access to the private room. If not, just know that the content and the quality of it is the same, no matter if it's a public stream or a private stream. There is no such a thing as, a secret sauce or something like that. So we're not keeping anything just for the private room. It's just more quantity, okay? And therefore, again, more discussion, more opportunities, okay? Anyway, so we're gonna look at the market. From there, we're gonna be review trades that we have. We have multiple trades running right now, so we have potentially some work to do. And then from there, we will look into finding more. Okay, so let's get rid of the introduction slide and jump into TradeStation. Here's our VIX chart. Notice the VIX is down today by 5%. There's been an important report today, isn't it? Like almost every Thursday, the report seems to have calmed a lot. Oh, I just typed the symbol wrongly. SPY, that's what I wanted to type. So the report seems to have calmed a lot the market participants, and options prices went down by 5%, while the S&P is up by 0.79% after the green UFO created yesterday. Okay. Now, careful, my friends, because we are in a down climate. So technically speaking, we are about to hit red UFOs, and this is based on stats, likely going to bring the market back down. At the same time, if the market goes down from those red UFOs and hits the green UFO, I would expect it to start going back up for a new climate. Why? Well, because the current red climate has been lasting for 2 candles already. Statistics suggest that 3 is the normal thing. So, if it takes another day or 2 for this to happen, we may be reaching what statistics suggest to be the normal duration for a down climate. And from there, we are back in business, and everybody happy out there in the world. I'm talking about the investors, the less active traders, because the S&P is back, on its way to potentially start making all-time high again. So so this is what the tools are telling us. So again, definitely we'll be happy to explore and exploit those different possibilities. Okay. Now, having said all of that, we have trades to review. First trade is TIM. This is an iron condor that we put together. Okay. We're gonna profit from this trade as long as that particular stock stays within the purple area from now until June 18. Obviously, we are right in the middle of the purple area, so it's actually looking very nice. I'm just gonna load OptionStation Pro. In parallel, I want to bring TOS, Thinkorswim, where you can see TIM. It's currently showing $50 of profit, where if you were to close this trade, you would close it for $50 of profit. Okay, so this is something for you to keep in mind. So when we did this trade, let me move to TIM first. Okay, so it's loading. On the way. Okay, so when we did this trade, we collected $175, and out of $175, okay, there are still 125 more to be made. Currently, if you were to close it, you would make 50. Okay, visually speaking, you can see it here. We are above. This is the zero line. We are above the zero line by $50. Here it shows 59. Okay, but really in TOS, it's because it's the real-time P&L. It's assuming that if you close at market, you're gonna get 55. Now it's 55. Okay, so again, there is a little bit of a difference, obviously. Okay, but it's not a major thing. That's the thing with options, right? So you always need to account for the beta spread. And so basically, all is looking good. Statistically speaking, the range should move from 253 to 200. So if we were to look at the chart and we were to readjust our lines, so 190 is now 200, okay, which is more or less here. Okay, and this is because that stock is up 4% today. So obviously that brought it up much higher to the midpoint of the range. And sorry, not this one, this one, and the upper part we said 253, which 253 is here. Okay, so that is now, it's funny, right? Because yesterday we were kind of perceiving or feeling that there may be a little bit of a challenge in the bottom part of the range. Now the challenge is more, if you wish, on the upper part. Okay, but again, there is no challenge so far because the dotted line has not surpassed the thick line, and on top of that, we are still protected by those 2 UFOs. So all looking good. So far there is nothing to be done on this trade. We will be working on it, at any moment in time. But at this moment in time, no need to do anything. Okay. Now, just for you to know, if tomorrow the dotted line, okay, surpasses the solid line, okay, let's see if you guys remember from the trade with Facebook. What should we do if tomorrow you recalculate your probabilities and the dotted line surpasses the solid line? What should we do? Okay, what should we do? This is a question for you guys. I will answer the question, but first I want to give you the opportunity that you answer yourself on the chat box. Okay, so I'll come back to this in a minute. Okay, then we also have Mastercard, okay, which is another trade that we have here. Okay, and if I expand it, okay, we can see that all those options also use June 18 expiration. So this is another iron condor, which in this case is showing a negative P&L of -5.5. Okay, so why is that? Well, many times, you know, one day, especially in a stock like Mastercard, which is not like super liquid. Okay, it's common that, you know, you need a few days, especially if you are still far from expiration. You still need a few days for time decay to basically absorb the bid-ask spread. Okay, so maybe that's why we see negative $6. Maybe no, maybe actually all of this is absorbed, but it's just that the stock is moving just a bit too fast within the range. And I would say that's probably the case, because that's a 2% move in one day, you know, straight candles, you know, just all the way. So, you know, probably this is what is, you know, impacting the P&L slightly negatively, even though I would not say that's a big deal. Okay, so if we look at Mastercard here in Option Station Pro, okay, and I'm gonna take a look at your answers in a minute in the chat box. Okay, so everybody please participate on that. So when we look at Mastercard, probabilities now suggest 394 and 344. Okay, so 394 is right here. Okay, and 344 is somewhere here. Okay, so definitely we are still good to end up in the range, but just like the trade with Tim, the upper dotted line is kind of challenging the upper solid line and maybe surpassed. Okay, so same question for Mastercard versus the question I had for Tim. What should we do, right? If tomorrow, Monday, Tuesday, okay, before we are back together next Wednesday, what should you do if, you know, that dotted line surpasses the solid line? Okay, and let me take a look at your answers. Siderman, change to Iron Butterfly. Maca, buy the calls back and sell higher. Maca, roll. Siderman, I didn't get filled until this morning at 67. 67. Okay. Let me see that, Mark. Okay, so this Iron Condor, this is Mastercard, sorry, let me go back to Team so I make no mistake. Okay, let's go back to Team. Okay, so Team is an Iron Condor where the strike price differences are $10. Okay, in other words, you have $1,000 of risk. Okay, and because it's 1 and you want to capture, sorry, it's not 1, it's 10, and you want to capture 15% of that, the minimum premium to be accepted is 1.5. Okay, so if you only got 67, you are taking lots of risk in exchange for the reward this trade may end up providing. So careful with that. Now, because expiration date is closer, now there may be more strikes available than when we did it, you know, the week before. So maybe you had you have different strikes than me, and then, you know, it's fine. But, you know, just keep that in mind. We want to capture at least 15% of the distance between strikes. If not, the reward to risk ratio of the trade, it's really not at its best. Okay, even 15% is not that amazing. That's our minimum though. So, you know, careful with that. Okay. Oh, with Mastercard. Okay, got it. So with Mastercard, sorry for that, Mark. So with Mastercard, looking at the strike price differences, so it's $5. So with $5, you need a minimum of 75. I got 74. I remember, I think it was Maca yesterday reported 77. So Siderman, if you got 67, again, for practice purposes, I would say a good one. But for real trading, real objective type of purposes, that would not basically meet the rules. Okay, at least the rules I use for myself. Which, again, if you want to use rules that are a bit less conservative, you know, I'm not saying this is wrong, but you need to understand the disadvantages, okay, which I'm sure you do. Very good. In any case, love it that you guys are engaged and you guys, you know, are putting the work, the practice, and you are reporting that on the chat box, okay? So anyway, coming back to what do we do if the dotted line tomorrow is above the thick line, okay? What do we do, okay? Well, you are not going to touch the calls, okay? You are not going to touch the calls. You're going to work on the put side, okay? So let's say tomorrow we have this, okay? We have this. So what does that tell you? Well, this tells you that, you know, price is likely to reach here from now until the expiration date, okay? But the fact that we have the 200 below tells you that price is likely to reach here but not below. So what would you want to do? What you would want to do is to take those puts that are currently 190, 180 and roll them up to that 193 mark, okay, which in this case, that if that was available, maybe that's 195 something. So again, I'm not sure what would be available when that's the case. You will need to look at the option chain. Of course, if it seems that we only have $10 of strike price increments, at least when we did the trade, so then 193, it's still the nearest to 190, so then you would do nothing. You would just wait, okay? But let's say, for example, this line was to be here, okay? So then you would want to roll your 190 puts to below that UFO, which is 200. So you would roll the whole thing up, okay? You will not roll the calls. You will not roll the side that is hurting you. You would roll the side that allows you to lock in a profit and sell more premium to try to offset what's happening on the painful side of the Condor. And we would want to do that as many times as possible until if one day actually that stock is not only the dotted line, but the stock itself is crossing the solid line, then we would take the 270 call and the 260 call, and then that roll would come all the way to the top with the puts, where you would end up selling the 260 put and buying the 250 put below. And then what you have done by doing that, and sorry, I'm using the wrong keyboard configuration here, so sell the 260 and buy the 250, and by doing that, what you just did was to convert an iron condor into an iron butterfly. So the butterflying of the condor is the last step, the last resource. In the meantime, it's going to be rolling. And the side that you roll is the side that is profiting for you, not the side that creates pain, okay? Because the fact that the dotted line is surpassing the solid line, doesn't mean you're losing money. Okay, actually, if you look at the P&L, that stock is currently making like $50. So it doesn't mean you are losing money. You're still accumulating time decay. You're still inside the range. It's just that now probabilities are less in your favor on the upper part. So you are anticipating that this may hurt by rolling the bottom part, collecting more premium, and still doing it in a way that is compatible with the method, which is using as a reference the dotted lines in this case below. Okay. Anyway, so this hopefully clarifies, okay? Sire Maya, try to get fill at 75 to 80 over and over when the mark was 85. I put in a market order. Oh, okay. Never use a market order, okay? That should be a rule for options trading, okay? We just don't use a market order, and we need to control those emotions, okay? I know your experience, Mark, but let's say I didn't know you and I read what you just wrote. So if you don't mind me to express a thought here, I would say probably the story behind the scenes was the trader tried again and again and again, lost patience and said, that word that starts with F, which I'm not going to say, and then it at the end, and then just did market order. Okay, sorry for that. Normally I'm not, a bit of that style, but I think that represents well the emotion of the trader at that time, and I wanted to be a bit visual. Again, sorry for that. It's really not my style, and that's a problem, because if you do it with a stock like Mastercard, it's not the most liquid in the world, but you're still okay. But there are some stocks that market makers are just going to take full advantage of you. Next thing you know, you saw 75, 80 available. Next thing you know, you get filled at 45, and you're going to be like, what just happened here? And it's the market makers not only saw the order come in, they saw it was a market order, and they just moved prices all the way. And now you are really in a bad position. So do not enter options trades. Sorry for that. Do not enter options trades, especially if it's multi-legs. Okay, I mean, let's make it a rule. Do not enter, right? But when it's multi-legs, it's even worse. Do not enter options trades using market orders. Okay, that's a big issue. Even, I would say, let's say you are trading directionally. Okay, let's say you are trading directionally, and you are doing, for example, a vertical spread. And let's say you are doing it on the SPY, which is super liquid. Right? And you're going to be like, oh, wow, it's only 2 contracts and it's super liquid, and it was not working my way. It's moving against me. I decided that price was my stopping point. I just want to get out. Market order to get out. Okay? Well, you may be okay if you do with the SPY, okay? But even with the SPY, there will be many times where the amount of slippage you're gonna get is massive, okay? So if you ever need to stop the bleeding on an options trade, you stock against, okay? So if you are in a positive delta position, sell shares against your options trade. If you are in a negative delta position, buy shares against your options trade. So now you neutralize it. And now that you neutralize the bleeding, you use a limit order to exit your options and then a market order to exit the stock. But don't use market orders with option strategies because, you know, we are trading a derivative here. It's a very powerful instrument, but by definition, the liquidity attached to derivatives is going to be much, much, much less, okay? Okay, good. In any case, you know, this is a great conversation to have. This is a great experience for you, Mark. This is great of you to share because it's helping everybody in the community as well. So this is great, okay? This is exactly what we should be doing in the sessions, which is, you know, provide you with materials, you then go practice, you know, and we learn. And sometimes learning is you know, making mistakes, or sometimes we do it right, and it's just a lucky moment as well, you know. So again, there is both sides. There is no right or wrong. What's important is to review, to discuss, to rectify if needed, which is exactly what we're doing at this moment in time. Okay, so good job, everybody. I'm super happy. I'm very, very proud to see all that activity on your end, guys. Anyway, so let's continue. PayPal. Okay, well, PayPal yesterday was a trade that we entered. This is a double calendar. So let's first of all, let's take a look at what's happening to PayPal. Okay, so here is PayPal. PayPal is currently making $41. Okay, 40. You may be like, how can that be possible? Okay, how can that be possible that trade is making money? Okay, and the reason why I'm saying that is because if you think about it, if I look at the VIX, as we saw at the beginning part of the session, so the VIX went down by 5%. So a double calendar or a double diagonal or even a calendar is a positive Vega position. Okay, so if it's a positive Vega position, how come volatility drops, at least the VIX, and that particular trade is making money? Okay, well, the key, and that's why patience pay, and that's why I am so persistent, right? And the price to pay is that sometimes, let's face it, some of our sessions sometimes they are a bit boring because you see me go through opportunity after opportunity, and it's like no go, no go, no go. Okay, so that's why we do it, because in this case volatility went against us, but the trade is providing some profitability. Why? That arbitrage opportunity that I talk about, right? When we looked at the volatility built in the options and we saw the front week had more volatility built in compared to the further expiration date, further out expiration date. So that is what is paying you. And again, we can observe that on the option chain. Let me get in there with PayPal, PYPL. Okay, so we are up here, you know, $40.51. It shows here. Okay, but when looking at the option chain, okay, so when looking at the option chain, okay, if you look at this, what happened? This guy was 39% yesterday, if I don't mistake. Today is 33%. Okay, where the 16th of July yesterday, I believe, was 32 or 33%, and is still 32 or 33%. That's the arbitrage opportunity I was talking about. Okay, so now when volatility increases, okay, the further out expiration date will increase more, because the further out the expiration, the greater the Vega. Okay, so take a look. The Vega values, okay, I'm just going to look at, this is a little bit of a crash course in options trading, okay, a little reminder, but the Vega values, I got theta, delta, okay, let me add Vega, customize columns. Here is Mr. Vega. And here we go. So the Vega values are 0.38, 0.39 for the call side, 0.38, 0.39 for the put side. Okay, this is where July 16. If you look at May 28, the Vega values are 0.15. Why? Because the shorter the expiration, the lesser the Vega. The longer term the expiration, the more the Vega. It's what it is. Okay, Mark, I think it was 39. Yeah, I think so. So yeah. So again, you can see how those different moving parts, we try to put them in ways that help us, of course, if we're right, but also offset some of the problems when we're wrong. That's exactly what we're trying to do, and today is a great example of seeing this in action. Okay, now having said all of that, let me load a few more strikes here. So I'll do 20, for example. So the strikes we are using on this trade are 230 and 260. Okay, 230 and 260. So if I look at 230 on the front wick, still trading at 80 cents. If I look at the 260, still trading at 146. So there is no opportunity for us to do rolls or anything like that. Of course, we still got 8 days and a half to expiration. So, time decay, extrinsic value, all of this is still at play with that particular expiration date. So we are just going to leave it alone. Okay, we just leave it there and that's it. Okay, so it seems that probably until at least a few days into next week, nothing will need to be done with PayPal. And definitely that stock started doing what we are expecting it to do. So far, all good. Okay, staying within the range, etc., etc. Anyway, so this is for the review for today, and now it's time to begin planning on trades. Okay, so what did I do today? So today I started, and you can see if I look at non-directional, I got a shorter list. Okay, compared to yesterday. You may remember yesterday when I scanned, I ended up both when I looked at top, like expensive options, and also later when I looked at bottom, cheaper options, I ended up with a longer list. Okay, but today what did I do? I went just a little bit more extreme because I saw that the VIX was going to open lower, blah blah blah. So then what I did is I just tweaked even more the scan, just to be a bit more picky. Since I got 3 trades running, now it's less urgent for me to enter more trades. Okay, this is how you want to think. I mean, of course, when we run the sessions together, I like to take as many as possible so I can demonstrate and you guys can practice as much as possible. But when I trade my own account, of course, if I have no trades, it's urgent for me to find one. It needs to meet the rules. I'm not going to break the rules, but it's urgent for me to find one. If I already have multiple trades running in my account and knowing that those trades take, a few weeks to get to expiration, so it's less urgent. So because I got 3, it's less urgent. Okay, so what did I do? Okay, not only I went to select bottom on this filter, I also went to select less than for implied volatility, less than historic volatility. In other words, I'm trying to find options not only very cheap, but even cheaper than very cheap. I'm trying to find the cheapest options of the cheapest options available out there. Why? Because, when building double calendars, again, if you start from a very, very low implied volatility value, then it's kind of like all profit as volatility rises. Now, of course, the disadvantage is that I end up with a shorter list. Okay, and what could happen? Well, what could happen is that then I have no trade. Okay, so what I'm going to do, okay, is I'm just going to copy those symbols. So Control C. I'm just going to put them here on the red screen. Okay, so I put them here. So then what I'm going to do, so we don't waste our time, I'm just going to go back to the normal settings I have, which is greater than, okay, and click run. So the scan reruns as well with the greater than instead of the lesser than. But in the meantime, I'm going to start working on those symbols here from the left so I can look into planning my trades, okay? That's what I'm doing, and that's the reason why I did it that way, okay? So Datadog, let's take a look at this company. And so I'm going to load it here. Also, we need to look at the earnings date, the next earning date. Okay, so notice how the current earnings took place in 6th of May. The next one will take place in August. Okay, so we got plenty of dates in front of us. So this is very good. Liquidity wise is looking decent. Okay, is looking decent. At least on that expiration date. So then this opens the door for us to explore. The other thing I saw on the screen that opens the door for us to explore is the fact that we got a collection of UFOs above, a collection of UFOs below, and probabilities are 48% or more. So all of this is very helpful for us to begin putting this trade together. you run it at 747, you got 15. Okay, got it. Yes, but I believe that probably your setting was not exactly like mine, because I just showed you, Siderman, that I had this additional switch, right? The less than. I did move that as well, okay? So anyway, so all of this is giving us green light for us to explore this further. We keep in mind that the next earnings are August 12. So now the next step to see if I'm going to take it or not is to find an arbitrage opportunity. That now you saw that in action, isn't it? And here we got a problem with that company. Okay, we got 16th of July, but we got no August. Okay, then it jumps all the way to September. And to be honest, from 12th of August, okay, from 12th of August all the way to 17th of September, there are too many days. It's like a month and a half. Okay, so we are indeed missing that expiration date, and it's a shame, because if that one was good, so we got 48 and 52. So notice that we have more implied volatility in the further out expiration, which would be desirable, but we're not gonna do it because we don't have any expiration date that is lining up close enough to earnings. Okay. Yeah, I hear you, Siderman. Very good. So no issue. We just go back to in here, and we're gonna click the next one, mRNA. Okay. So next earnings for Moderna will be August 11, so more or less the same date. Okay. So we're gonna wait for the chart to load in parallel. I want to fat finger. mRNA load Moderna on the option chain and see if we have August 11 or close by available. So let's take a look. I'll have a sip of water as well. We don't. We have 16th of July and jumps all the way to 15th of October. Okay. So we don't. So we cannot do it. So no issue. We go for the next one. Mitch. Okay. Did I just say Mitch? Why did I say Mitch? It's not Mitch, it's Match. Anyway, the next earnings is 10th of August. Okay. So let's do the same thing again. Okay. Right there. Let's see what expiration dates are available. And I haven't looked at the probability of the UFOs. To be honest, the sequence doesn't really matter as long as you check everything. Okay. It is taking a while on the chart too. Okay, so just waiting. Should show up in a moment. Okay, come on. I believe we may have data from the prior loading process I started. Download, oh, there is nothing in the download scheduler. Okay, interesting. Okay, so I guess that we're gonna have to wait. Okay, we have it here. No, this is still Moderna. Okay, so there's been a timeout on the chain. So let's load it again. Let's see if this time is gonna work. Please wait. This happens to me from time to time, to be honest. You know, as you may know or you may not know, I am located in Asia. I am in Singapore. And so what happens is that, you know, TradeStation servers that are located in the US, they don't often replicate market data in other servers located in other places in the world, and sometimes I just get a bit more latency than you guys in the US. Okay. Yeah, good idea, to be honest, to save time, Siderman, to check on TOS. Okay. Well, 59%. That's beautiful probabilities. Okay. Well, it didn't load. Still didn't load. So let's check on Thinkorswim. So it seems that there is no expiration date until September, based on what you said. Yeah, so we got July and then it goes to September. Okay, so we cannot. So we're gonna look at the next one, which is PTON. Okay, and by the way, when you get your filtering parameters to an extreme, like I've done, because I'm not in a rush, okay, today. So the problem is that, I mean, there may be a reason why those options are so cheap, okay? There may be a reason, and the reason is because earnings are so far away that there is no perceived risk nor opportunity, and therefore those options, you know, are trading at a very low price. So that's great, but at the same time, the issue is that because it's a very far time from now, you may not have an expiration date that lines up well. Okay, so it's kind of like the sweet spot is more like around, you know, let's say a month and a half, something like that. This is when you find normally more opportunities that will match expiration dates. Okay, so PTON is the same story. Okay, so we have July and September, no August. Okay, so then we are not going to be able to take that one. So what about the last one, Shopify? So let's see what's going to happen with Shopify, and if not, we have the scanner almost ready, okay, which is again something I was expecting. That's why I started loading the scanner in parallel, because again, when you go very extreme, this is what tends to happen. But again, I love those extreme opportunities because you know, you can build this buffer that allows you to be wrong and still absorb the problem. And we saw that perfectly today with PayPal. And you know, the more extreme you go, the bigger the buffer you tend to build. Okay, so it's always worth it for me to take a look. No need to be in a rush, especially when you have multiple positions already in the account. Okay, and then of course, you know, I guess I would need to admit that sometimes, even though I try hard to not to be a perfectionist, sometimes I just cannot help it. So yeah, that's probably the other reason. Okay, but anyway, so Shopify have July and September, and when it comes to earnings, July and September, and when it comes to earnings, we are looking at oh, that's not possible. 20th of May, they have not updated that. We saw that yesterday. This is pointing at August 4. Okay, so anyway, so yeah, so with that list of stocks, we didn't have any opportunity that met our rules. Okay, so here on the red screen, I'm just gonna delete those symbols. Okay, and with that done, the scanner is about to conclude. It seems that it's narrowing down at this point down to 26 symbol. Easy language is being processed, so I guess that we are just a few seconds away from seeing our list, and then we will work on that. It is so cool, guys, that we can run scans of this sort, because imagine doing all of this analysis manually. Okay, that would really, you know, basically discourage you, right? Or you know, maybe you would be more easygoing, okay? But then that would be less probability, okay? So now we have all those other trades, okay? So and now let's go ahead and take a look at what's possible, okay? So Amazon, if that's okay, I'm gonna skip it, okay? I'll start with Netflix. Again, perfect stock to trade Amazon. I'm not saying anything against Amazon. I'm just saying that it's you know, for practice purposes, you know, if you're in learning stages, a $3,000 stock is not ideal at all. Okay, so when looking at Netflix, okay, we have here earnings on the 19th of July. This is, if I'm not mistaken, the same that we saw yesterday with PayPal. So we were using July 16 for PayPal because it was quite close. So that would work. Okay, we got more than 50%. That's good. Now the red UFO is so far away with Netflix. Okay. So I really hope that with pre and post market we get more UFOs and good probability, and we don't. So you know what? I'm just gonna move to another stock, okay? Because then it's gonna put me in a super ultra wide range, okay? All the way here to 555, okay? Yeah, so it's looking like, at least visually speaking, like a very wide range. So I'm just gonna move into W. W has earnings on August 10. Okay, so we may have the same problem with W. Of course, July, we know July is going to be a better bet, isn't it? So that, by the way, is another way to approach your screening. Okay, so you can come in here and say, okay, these are my symbols. Oh, you know what? Look at that. With W, we have 20 of August. Okay, and the earnings is 10 of August. Okay, so I would say close enough. Okay, now we don't have the arbitrage opportunity because you can see that that expiration date got 58%, where the front week is 53%. So the further out expiration date option is already more inflated than the front week. Okay, so no, we cannot accept it. Okay, even though we have the date this time, we cannot accept it. Okay, so let's continue our research, looking for the right company so we can plan the right options trade. So let me go ahead and look at BA MMA. So BA has earnings on July 28. So July 28. Just gonna focus on expiration dates, okay, just to rush the process a bit more. Okay, July 28 we don't have, we have July 16, and we have 36 and 36, that's BA. I'm not saying it's not doable, but it's not ideal. So I'm going to try MMM. MMM 3M, I should say, is reporting earnings in July 27. So let's take a look at what's available with 3M. July, we have July 16, and this is 21 and this is 20, so it doesn't work. What about GME and Walmart? So let's take a look at GME, and I will load GME as well here so we can compare. So GME. So GME is reporting earnings 20 of May, well, that's today. Okay, Walmart WMT. Walmart is on August 17. So WMT. If we got August 20, that would be perfect because it would line up very well with August 17. And we do. Okay, we do. And this one is 20% and the front week is 18. So we don't have the arbitrage opportunity, okay? We don't have it available. So then I'm gonna continue. The next symbol then it would be SPG and HLT. So SPG which is 3rd of August. We got July and then jumps to October and Hilton. So let's take a look at Hilton. HLT earnings on 28th of July. So that may work. Okay, let's see what's possible. So Hilton, no, it doesn't. We got 16 and then we got 15. Okay, so just a bit too far. Okay, so we continue with Caesar and Royal Cruise. RCL is Royal Cruise Caribbean, I believe, right? Yeah, Royal Caribbean Cruises, exactly. So Caesar. So CZR earnings on August 12. We got July and September. Yeah, RCL, Royal Caribbean, RCL. We got earnings on August 3. So let's see, we got July and September. Okay, so little bit of a teaser today. Yesterday was so easy to find the trades. Today is not. TSN and Bristol Myers. So TSN. Okay, TSN with the next earnings on August 9. So let's see what's possible for TSN. Okay, we got July and October, so no. BMY, Bristol Myers, BMY. Next earnings earlier in July, but it says May-20. That's, yeah, I cannot rely on that. Would you mind to check Maca or Siderman on your platform TOS? What's the date? Is it like July 29 for Bristol Myers? Yeah, in any case, you know what? You don't need to check because we only have July 16. I thought for that one we will have August because it's, you know, normally more liquid. HIG, okay, and MPC. Okay, so HIG, okay, that is same story. It's looking at end of May. Yeah, and what was it? The next one, MPC and United Airlines. So MPC, that I was not expecting. So many stocks with the same problem. July 29. So let me see when the option chain loads. MPC, we got July and October. Okay. No, and then United Airlines, that's the last one in the list. UL, and we are now dealing with 20 of July. So 20 of July, certainly we can work with 16 of July, and then we got 49% and we got 45%. So unfortunately, with none of those trades, we ended up finding the arbitrage opportunity. So there were 3 or 4 symbols that met the rules with the expiration date to be very close to the earnings date. That we found, like it was 3 or 4, I believe. But unfortunately, the expiration date lining up with earnings, which is the further out expiration date, was providing greater implied volatility values compared to the front week, which is the opposite of what we saw on PayPal yesterday. And, you know, that's what we're looking for. Because, you know, this is kind of, I mean, we cannot call that free money, it would be way too exaggerated, but there is some component of, you know, an arbitrage there in that type of approach, okay? So anyway, so yeah, so we're not going to be able to do this, and therefore we're going to have to change trading style. We're going to get directional, okay? We're going to be looking at those 3 particular companies. I mean, let me take a look at the S&P again. So the S&P on a down climate hitting red UFOs, okay, so then I would certainly want to find opportunities for me to make money as the market falls. And therefore I'm going to look at that stock with 59% probability. That's good. What about pre and post market? Well, actually, yeah, doesn't work with pre and post market. Would only work with regular session. Okay, what's the issue? Well, the issue is that the next UFO is located at 146, where our reference value for the short is 141. There is no UFO nearby, and therefore there is no trade. Okay. Also, today is candle 6 out of 6, so it's either you take a trade today or you don't take it anymore. So it's kind of like, you know, you're getting to the end of the climate. Okay, so. We want to keep that in mind. PINS. Hello, Jose. Nice to see you in our YouTube channel. So we got 51.97%. That one I'm going to pass. Okay, why? Because it's 16 out of 5. So that market has been falling for way too long based on statistics. So it may be, you know, those green UFOs that just showed up may be the reason why this stock is going to completely reverse. Okay, could be. So I don't want to be exposed to that potential situation because it would be against me. So we're going to look at Sonos. Okay, and see what do we have. And the same story I'm going to pass because it's 16 out of 5. So we're not going to do that. And MGNI. Okay, so waiting for this to load. Same story. We got 13 out of 5. so we are also going to pass. Okay, so I wanted, obviously, given what the S&P is doing, where the S&P is in a down climate and we are hitting red UFOs, so I wanted, to position myself to make money as the market falls. Now I cannot do that, okay, immediately with the stocks from my list. So what I could do though is, wait for those UFOs to bring the price down, and when it gets to that green UFO, potentially it's gonna go back up, right? So then I could start looking at potential opportunities to be a buyer. I got 3 stocks, okay, with Datadog. It's the first one with 52% probability. This is a new climate that started 4 candles ago. It's supposed to last for 8 candles. Our reference price for the trade would be 82.42. So we want this to fall from 87 to 82 so we can ride a move. That's what we are trying to do here. That UFO is 83, that UFO is 81. So it's kind of like 82 is in the middle. Okay. At the same time, I haven't checked pre and post market, which is 39%. So that is not good enough. But regular session, it is showing 52%, which is indeed good enough. So now, what's the issue? 82.4 is somewhere here, which is kind of like exactly in the middle. Okay, so you would think I cannot take the trade. Okay, but at the same time, I believe that it is absolutely fine, because the top part of that UFO is 81.91, so it's almost 82. And by the way, the current value of the stock is 87.67. So for that market to reach the entry around 82, it has to fall by $5. So what's going to happen to the moving average if the stock falls by $5? Well, the moving average is called moving for a reason. It moves, and it's going to move down, right? And therefore, while currently it's pointing at 82.39, it is very likely going to point at 82 or 81 point something when we get to these particular UFOs below. Therefore, those 2 UFOs that are overlapping each other will represent my entry point, being the one on the top, 81.91, and therefore I am now in planning mode, planning a trade with Datadog. So let's go back to the option chain. Let's load that stock. And this seems that it's going to take us to the end of the session today. So you guys in the public streams, you'll stay with us until the end today, given the fact that we were not able to find an opportunity sooner. So I'll wait until the end, okay, guys, so you guys don't miss it. So we said 81.91. Okay, so that would be the price that would represent our entry. Okay. Now, before we get too excited, we also need to set a target, right? So to set the target, since you are basing this trade on a daily climate, so I'm just gonna move to a daily time frame. And when price is already inside of a UFO, which is the case, then to set targets, you want to ignore that UFO. Why? Because first of all, in an up climate, sell on-field orders tend to be cancelled, so that UFO is not that relevant. Second, the fact that price is inside the UFO already, not only that, especially the fact that the inner circle inside the UFO has been traded through, that means that most of the on-field orders have been filled, and any moment that UFO may go away. It may not show on the screen anymore. Therefore, the next one we're going to use is the one we're going to use for target, and therefore my target is going to be 91.96. Okay, so 91.96 is going to be the location for my target. So I'm going to enter at this price. I'm going to exit at that price in case I'm right. We will talk about management techniques during the life of the trade, assuming we get filled. And in the meantime, so what I need to calculate is, if I look at the difference between 91.96 and 81.91 is about $10, isn't it? So it's $10.05. So I need to make sure that the expiration date I use allows me for at least $10 of move. And $10 of move based on implied volatility is that one at the minimum, at least 22 days. At least 22 days. Okay, so June 11 is the minimum expiration date for me to use. But notice I repeated minimum many times. Why? Because I also want to align that with the expiration date, which is August 12. So that way I get less penalty on theta And when implied volatility start rising as those options gain value because of the natural effect of earnings approaching, so that will offset some of the theta lost. So therefore, August 12 is the ideal expiration date I want to use. You may recall earlier that we didn't have August 12, okay? And therefore, I do have a problem here, okay? We cannot adjust this the best way we could, and therefore I'm gonna have to go with July 16. Is the best I can do. Definitely, I'm giving myself, more time to reach my target, and the target could be up to $16.92 away, which we only need $10, okay? So then that's gonna be good enough. Also, you may say, Jose, what about we go for the next one, 17th of September? Well, the further away you go, typically you would have a bit more slippage, okay? So 40 cents of slippage, plus the trade is $900, where if you do it with this one, July, is the nearest we have to the earnings, right? And now the slippage is gonna be 25 only, right? Instead of 40, and the cost of the trade is gonna be 500 something. So the most you can lose is 500 something if you were to buy a call. So again, it's gonna be more balanced from liquidity and cost and return on investment point of view. So we're gonna go ahead and enter a few simulated trades to analyze what's best. The first thing I would like to analyze is what happens if I buy a call, and that's it. So I just added that. Second thing I want to analyze is what if I was to buy a vertical spread. Okay. And the third thing I would like to analyze is what happens if I buy a diagonal spread. Okay. So we're gonna play with those different possibilities. Okay. Which I'm gonna uncheck and recheck one at a time, so we can plan those trades accordingly. Okay, so we're gonna start with a call, and here is very simple with a call. You just wanna find a call which is providing more or less 30 delta at the time of the entry. So the current call we're using is the 90 call. That one is providing too much delta, so I'm gonna go for 95. That is providing 35 delta, which is more or less okay. But the problem is that that call would be located above my target. So in other words, when I get to my target, that call would still be out of the money. Okay, would still be out of the money. And that is something we don't want to do, because if it was to take too much time to get to the target, then the erosion of extrinsic value in the form of time decay would be way too great. So doing a call in this case simply doesn't work, okay? Given the deltas associated to these options, which had a lot to do with implied volatility built in at the moment, which is quite high, as you can see, 59%, okay? And given the fact that, oh, wait a minute, I have multiple things selected. Okay, wait a minute, let me rephrase that. Because now if I deselect that, it shows 24. I'm not sure what happened before. Maybe I made a mistake. So what if I do 90? Okay, so you know what? I just changed my mind. I had made a mistake with my checks. So now that I only checked the call, okay, so now I got about 30 delta if I use the 90 strike, meaning that if I get to my target at 92, I would be $2 in the money. So at least I would have some intrinsic value together with the extrinsic value. In other words, that option strategy could be okay. Okay, so I'm gonna uncheck it, leave it alone for a while, okay, which is the 90 call. Okay, and now we're gonna be looking at what if we do a vertical. Well, if I do a vertical, okay, I'm gonna have to buy an option and sell an option. So the rules we have is that the options we sell need to be above 92. Above 92, okay, it's pretty simple. I only have 95. So if I do 90.95, and I check that, okay, this is providing me with 9 delta only. Okay, so I'm gonna have to rise 95 and make it 100, and now my delta is 117. I could rise it a bit more and make it 105, and now my delta is 22. I could rise it a bit more and make it 110. My delta is 26. I can rise it a bit more, make it 115. My delta is 28.97. I would say this is good enough, okay? Because I think that if we go to the next one, 120, well, 120 is actually perfect. It's 30 delta, okay? So that would be the one. So 90 and 120, that would be the other combination, okay? So I will keep that there and we'll analyze that in a minute. Okay, and then we have the diagonal, which is gonna be, let's do 90, 120. I'm gonna do the same one as the vertical. Okay, but instead of using 16th of July in both cases, we're gonna do 16th of July and 28th of May. So if I do that, oh well, I did that backwards. So sorry, let me do this. Here we go. So sell the 120 and buy the 90, and that provides a delta of 30.54. But you know, I'm not liking what I see where the midpoint is the same, no matter if it's the vertical or the diagonal, which may tell me that the 120 pays absolutely nothing. Okay, so let me take a look. The 120 here pays 55 cents, and the 120 in the case of the 58th of May pays what? The 120 pays, oh wow, major slippage there. Okay, major slippage. Okay, that cannot work. Okay, you see that? 2 cents to 108. So yeah, so we cannot use such a far located expiration with lack of liquidity, which forces me to come to 18th of June, and that still not good. Okay, lack of liquidity there on that one. Only the one in July has a liquidity that is, you know, let's say fair enough for the 120 with 46 cents to 63. Okay, the other expiration dates are not good. So in a normal case, you know, I would examine what happens with the diagonal, but in this case it's not worth it because, you know, you would maybe not even get filled if you do this trade. Okay, so you know, the question now is, what is best, to use the vertical, which is 90 120, or to use the single, which is just buy the 90 call? Well, notice if I buy the single, that is going to cost me $323. Okay, that's the estimation. Let's call it 350. Okay, in exchange to get a 34 delta. And if I do the spread, instead of 300 something, is going to cost me 300 flat for the same 30 delta. So in this case, by the way, in both cases, everything is positive gamma. Okay, so it's not like I got a negative gamma at target, which is a normal thing that may happen when you do a spread. In this case, it's all positive gamma, meaning it's all working in your favor all the time. And therefore, the vertical spread in this case is a better choice. Okay, so this is the trade that we are going to implement. I don't think we're going to get filled today, okay, because we need the stock to drop by a large amount to get filled. Again, if I go back to the stock, it needs to drop from current price, which is 87, all the way to 81.91 here. So that's a pretty major drop. I mean, could it happen in one day? Oh yeah, it could. Is it likely? I would say not so likely. Okay, so I will leave it to you to watch it, maybe set an alert, and if it gets there, then buy the spread. But probably what is more likely to happen is that the S&P hits those red UFOs, and the market today on Friday is in falling mode. And as the market is in falling mode tomorrow on Friday, just to complete the one more day of down climate statistics suggest, again, may or may not happen, but statistics do suggest that. So then tomorrow you may have an opportunity to get filled. Okay, so keep that in mind. 90 120 using 16th of July, and just place it again on your analytics tool to resimulate. Make sure you have whatever Greeks you got with around 30 delta, and make sure you understand the risk of the trade, which is basically the cost of it. Okay, because the most you can lose when you buy a spread is what you pay for it. Correct? So make sure you have that in place, and you have that under control. So let's say you want to risk $600, so you know you can go with 2 contracts. Let's say tomorrow there is an increase in volatility, and this is costing you $400 per contract. But if you do 2, that would be $800 of risk, which exceeds your $600, assuming that was your case. So review this tomorrow. But it does look like 90 120 could be a good combination using July 16 for tomorrow, assuming Datadog is falling down into 81.91, which is our entry right here. Okay, So my friends, the session is basically over. I just went a little bit beyond the ending time of the session. Ahmed has a question. Jose, I will set my target to exit the trade. I will not wait to expiration, right? Yes, absolutely. So not only expiration, you need to monitor expiration. You need to monitor the target. You need to monitor the earnings date in case they were to change it, which could happen. And yeah, so that's what you need to monitor. And then as we get filled in directional trades, we will also exploit tweaks and rolls that we can do during the life of the trade to lock in profits while the trade is developing towards our targets. Okay, so there'll be some additional action to be done, but definitely we are not going to wait all the way to expiration and hope for the best without doing nothing. Okay, so we're going to be acting on this. Okay, so yeah, absolutely, Ahmed, that's the way to think. Very good, everybody. So I believe that we are done for today. We are done for the week, actually, with me. Tomorrow, if I'm not mistaken, Becky will be doing Solid as a Stock, so don't miss it. And keep up the good work, everybody. Again, I'm happy to see your activities. I'm happy to see the questions. Keep up the good work, my friends. This is the way to do it. Count on us, guys. If you have any questions as well, shoot an email to support. And again, stay connected, and let's keep going, guys. See you soon. See you next week. Bye bye, everybody. Take care.